Hello, this is Brian Rezny, president of Rezny Wealth Management and host of the Rezny Wealth Report. We've got an excellent show for you today, and as always, we will be taking your questions. Send them to Brian Rezny at ReznyWealth.com, and make sure you do visit our website, ReznyWealth.com. Rezny Wealth Management is a fee-only fiduciary money management firm. We're not Wall Street. We don't sell annuities. We don't do free steak dinner seminars. We actually manage our clients' money, and as a fee-only fiduciary, we legally work for you, the client. Wall Street firms cannot say that. Insurance companies cannot say that, or banks. About 10% we estimate are fee-only fiduciary money management firms in this country. Make sure who manages your money, who you entrust with your life savings, is a fee-only fiduciary money manager. Today's topic, I want to talk a little bit about investment bubbles. You know, every single year, maybe every 3 or 4 years, there's kind of a new bubble. There's a new investment fad. There's things people are talking about. Investment bubbles come and go. But unfortunately, a lot of individual investors get caught up in these bubbles and ultimately lose a lot of their net worth, or maybe all of their net worth. You know, I hear a lot of things about Bitcoin the last couple years and cryptocurrencies. I remember before you heard a lot about 3 years ago about cryptocurrency or Bitcoin, everybody was talking about buy gold. Gold's going to make you a fortune. Gold's done pretty lousy, to be brutally honest, and it's not a great inflation hedge. There was housing. Remember the housing bubble back in 2006 and 7? Everybody was going to get rich. Buy a spec home, buy a couple of houses with no money down. What happened? A lot of people went broke and bankrupt in that bubble. So bubbles are going to come and go. Bubbles come and go in all types, whether it's in the bond market, whether it's in the stock market, whether it's in real estate. Maybe you invested in a bubble investment yesterday or 20 years ago. Maybe you lost a lot of money. Before you get suckered in to the next bubble craze, make sure you truly understand the investment you're getting yourself into, the risk, and any investment that goes up 50, 60% in a month or two or a year, that should be your first radar worry that something's going to go wrong. No investment goes up 50 or 100% a year or 500% in a year and keeps doing that. When things go up too quick, too fast, they often deflate even faster, and it's too late for you to get out, and you've lost your life savings. I often hear from investors when they call my TV or radio show with questions. Brian, this time is different. That's not going to happen in real estate. I heard that a lot back in 2005 and 6. Those people that told me that, they'd call my TV or radio show years down the road, and they told me, Brian, you were right. We lost half of our investment net worth, and we couldn't retire anymore. We had to go back to work. So again, don't get suckered into bubbles. Don't get suckered into get-rich-quick schemes. Methodical investing, a lot of research and discipline is how ultimately you can create real wealth over long periods of time. When do bubbles pop? I'm often asked. You know what? You don't really know. I look at Bitcoin, and I think Bitcoin and cryptocurrencies, to be brutally honest, are a huge bubble. It might go up for another year or two before it deflates and pops, or it might deflate tomorrow. These things often are chased by small investors, and they pile more money into these investments, and eventually it's called the greater fool theory. Once the last fool has put all their money into the investment, there's nobody else left that's a fool, and the bubble pops, and ultimately everybody, or a great percentage of the people, lose a lot of money. What's the biggest bubble today? Well, I kind of mentioned Bitcoin or cryptocurrencies in general. But you know what? There's a lot of other ones too that I see. Overinflated stocks. Some of the areas of the bond market are grossly really in a bubble type predatory or overinflated. So you know what? It's not just one investment. It could be a group of investments or a lot of different investments. So again, hardcore research and buying investment assets that truly have a catalyst to grow in value is the only investment that should be put in your portfolio. But once you buy an investment, constant research is required on every investment you own, not only before you buy it, but every single day after you buy it until you decide you're ready to sell for greener pastures. Let's talk a little bit about the herd mentality. This happens where people just keep piling on. They hear something, a buzzword about a particular sector or investment. They keep piling on until there's nobody left. News hype from the internet. There are so many fake articles that look like news that hype up different investments or different medical cures maybe or whatever, but people get suckered into these also. I see all kinds of crazy things on the commercials on a lot of the cable stations now where people are claiming, oh, they've changed the IRA rules and the IRS is coming to take half of your IRA. These are not new rules, by the way, and the IRS is not going to take half your IRA from you. Ultimately, make sure what you're reading and what your research is real research and real information, not a sales pitch that is disguised as a news article. Chasing what's hot now will burn you every single time. When the year end comes, I get a lot of individual investors that call my TV or radio shows, and they start asking about the hot stocks from last year that were up 60%, or the hot mutual fund, or the hot this or that were up 30 or 40% maybe when the market was only up 10. They want to pile into these things after they've already made their run. So again, sometimes there's certain sectors that should be bought, but then they get overbought and overvalued. And then when you see these grandiose numbers at year end, that's when people want to get in, and that's often the time you want to be selling and looking for something else that is of better value. By the way, if you're not sure what you should be doing with your money, if you're a higher net worth investor, and maybe you're not happy with the way your money's been handled, we've got a couple workshops coming up. Check our website for details. The disturbing facts most investors are shocked to learn. Learn from others' investment and retirement mistakes so your portfolio in retirement is not devastated. Again, it's cheaper to learn from others' mistakes, and I'm going to teach you a bunch of those and a whole bunch more. To learn about my talking points and to sign up for our upcoming workshops, go to reznywealth.com for dates and availability. Let's go to Doug in Naples, Florida. Hi, Brian. My wife is a Collier County school teacher, has a 403B with an insurance company, a 2% annualized interest. Total value now is about $36,000. 10-year minimum lockup is now over. Does it make sense to change some of the investments in the 403B? First off, I do not like annuities, period. But if you work for any school district, you work for a municipality, often annuities are sold to a lot of unsuspecting investors. That advisor or that salesperson that comes and knocks on the door at the school is a salesperson, and that's it. They're not a fee-only fiduciary money manager, so they don't legally work for you, nor do they actually manage your money. They're trying to sell you the investment plan that the school signed up for, that the school didn't do a good job deciphering who and what products they should actually be offering their school teachers or their government workers. That's pretty sad. But again, the people on the board are probably not money managers, so they don't know how to decipher who to bring in or who not to. Annuities in general have high expenses, and I do not like annuities. If you're younger or middle-aged or even older, if you're trying to grow your money, annuities are not the way to go. So really you should be looking for other options within that 403B plan at work and see what other options you have available to you. Unfortunately, what you're going to find with a lot of these plans is limited investment options, often high expenses, and you really have to pick. So what you want to do is do the best you can with what the options the school district gives you, but if there's some point in time where they allow you to do what's called an in-service transfer to a self-directed IRA, take advantage of that if you can get help from a fee-only fiduciary money management type firm like a Rezny Wealth Management. Folks, I'm going to take a quick break. I'll be back with more questions after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. Investors are getting smart. They are moving away from conflicts, bad advice, and being sold junk investments from firms that are not family fiduciaries. Smart investors demand real advice and real money management 100% of the time. If you're tired of the financial runaround, download my groundbreaking report, 3 Investment Risks You Must Avoid Now. And we're back, and I really enjoy the questions we're getting. If you'd like to send us a question for today's program, send those to Brian Rezny at ReznyWealth.com. And as always, visit our website, ReznyWealth.com. You can sign up for instant email alerts about the economy, the markets, all kinds of good information we try to educate you, the investor, with, so you can make better decisions around your investments and your retirement. And as always, if you're questioning the advice you're getting, if you're realizing a lot of the stuff that I talk about that should not be in your portfolio is prevalent, and you're realizing the service you're getting is not money management at all, call our office for a consultation if you'd like to talk to us about managing your wealth. Mike from Naples, Florida. What strategy would you use to invest excess cash in the current market? Mike, great question. So generally speaking, you might have heard the term called dollar cost averaging. Dollar cost averaging is where you put a little bit of money every single month into your overall investment portfolio or your strategy. What I would say, though, that doesn't really pertain to you. So if you have excess cash, let's say you've got a portfolio of $200,000 and right now your excess cash is $50,000. I would get that to work in the next 3 months at a maximum. If we get a pullback in the overall investment markets and you could buy some things a little bit cheaper, get it invested right away. But we don't know if we're going to get a 3% pullback next week, or the market's up 3% next week, or somewhere in between. So what I would say is, as long as it's money that's longer term money that you don't need for the next year or two, get the money invested sooner than later. A lot of people lose a lot of returns waiting, hoping we get a pullback, only to miss a 10% increase maybe in the value of the investment they were looking at before it ever actually corrects. So over a long period of time, don't try to short-term time the market. Get the money invested, or at best, spread it out over 3 months and get it invested as soon as possible. Marvin in Florida. I'm in the process of evaluating some local investment advisors. How do you find out if they've ever been sanctioned? That's a great question, and I wish more people ask questions like that. So Marvin, what you can do is if you go to ReznyWealth.com, our website, scroll to the bottom of the homepage, you're going to see a fiduciary questionnaire. Real advisor, fake advisor, free report. Download it. It's a questionnaire. On the last page of that questionnaire is the Security and Exchange Commission website and the FINRA site. What I would suggest you do, though, is use the SEC site, and at the top of the search box, type in the name of the firm that you're thinking about using. So whatever the name of the firm is, if it's Rezny Wealth Management, type in Rezny Wealth Management at the top of the search box and hit search. See what comes up. What you're going to find is if you Google or if you search any of these major firms or even these smaller firms, a lot of them have been finder censured hundreds, sometimes thousands of times, and often for billions of dollars for misdoings against you. So Marvin, I'm glad that you're actually asking about checking out the firm or the firms you're thinking about utilizing. Most people never do that, nor do they understand that you can actually check out these firms through FINRA or the SEC. But again, go to ReznyWealth.com, scroll to the bottom of the homepage, download that free report, Real Advisor, Fake Advisor, Fiduciary Standard. You'll be glad you did. It will help you a lot in your quest for real information. Also, Marvin, you might want to attend one of our upcoming workshops. The disturbing facts most investors are shocked to learn. Learn from others' investment and retirement mistakes so your investment and retirement portfolio is not devastated. You know, I've been managing money for well over 30 years. One of the saddest things that I see is investors making the same mistakes over and over and over again when you don't have to. In fact, I was talking to a client just the other day who is referring another client to us. And they were telling me about how the husband basically passed away and he basically didn't do the right things with the money, and now the wife is really suffering and really kind of short on cash. Didn't handle the pension correctly, and now when he passed away, the wife lost the pension and things of that nature. If you're talking to a qualified firm that understands how these things work, they should be giving you quality advice on how to handle these things before it happens. And I can tell you, managing money for over 30 years, I've seen so many financial mistakes made by investors, often because of they're using so-called advisor firms who are really sales organizations, and they're not getting any real advice at all. Again, one bad choice with a pension plan, or when to take Social Security, or a couple mistakes in that investment portfolio can wreak havoc on your retirement and your financial security. As I've always talked, the only kind of firm you should entrust your money to, if you care about your money, is a fee-only fiduciary money management firm. That's the only kind of firm. Anything less is a sales organization with a ton of conflicts that's ultimately going to work against you and your hard-earned money. Go to ReznyWealth.com, check out our firm, check out our consultation page, and find out if you qualify for a consultation and how we can benefit you in your future endeavors. Dwight in Florida. Hi, I would like to know why Pfizer is losing value since the FDA approved, probably I'm assuming, their COVID drug. You know, that's a great question. And let me explain what happens in general. Investors will buy, let's say, Pfizer, because, oh, it's Pfizer, it's a big name company, everybody's heard of them. And they have this new drug that just got approved by the FDA, so they think magically this price is going to go up. So Dwight, what I'm going to tell you is this. The market, analysts like us, or firms like us, look at this stuff all the time. If Pfizer was a good stock and we feel they were going to get approved, we would already have bought that stock months and months and months well before they were going to be approved. So what I'm going to tell you is we call it as good as it gets for right now. So Pfizer's going down because it's as good as it gets right now. What's the next blockbuster going forward? They're working on some things, but maybe nothing that's going to happen in the next 6 or 12 months. So what I'm going to say to you is this. Investors grossly underperform with their portfolios. Delbar, an independent company, studies results from investments and investors just like you, Dwight. And you know what they found? Most investors make half what the market makes on the bond market and the equity stock market. And why is that? A variety of reasons. But a lot of it is they buy things that they've heard of without any research. They buy things that have already done well without any research. They don't have an investment strategy or research, and unfortunately, that's ultimately going to cost you a fortune in losses in your portfolio. This is what I'm going to say to every investor listening today. Questions you should answer for yourself. And Dwight, this is you too. Before you bought Pfizer, what research did you actually do before you bought it? Did you do any real research? Did you look at the company reports? Did you drill down on valuation, future growth, things of that nature? What is your daily research after you bought Pfizer? Most people will buy a stock or an investment without any real research. They buy it because it's Pfizer and that's it. Or it's Microsoft or whatever. So once you buy it, you have to do daily research on that investment every single day. And research isn't looking at the price of the stock. It's what's changing in that company. What is the 5-year future earnings growth for that company? If a company has a bad 5 years future growth forecast, there's a good chance that stock may just drop in value. What is your investment strategy? What triggers you, Dwight, to sell that stock? Whether it's valuation, loss of market share, bigger competitors, better competitors, what triggers your buy strategy before you bought that stock? So these are all the kinds of things that we look at as a firm on all the investments that we're purchasing. But I will say this, most investors, they buy stocks or investments only because they heard of them or they've gone up recently, so they jump on that bandwagon. And that's why most investors, based upon an independent Delbar study, make half what the market makes, whether it's bonds or equities. And that's pretty bad. Managing money requires a few things: a lot of time, a lot of daily research, a lot of knowledge, patience, discipline, and of course, strict strategy. And you have to adhere to that. Most investors are not willing to do that. And it's unfortunate. But if you're going to manage your own money, you better plan on spending 20 to 40 hours a week minimum on research, daily research. Have a good strategy and have a lot of patience, discipline, and maybe you'll have a good chance of a return on your portfolio. As I've talked before, we've got a couple upcoming workshops. Go to ReznyWealth.com. That's ReznyWealth.com. The disturbing facts most investors are shocked to learn. If some of the things I'm talking about on today's program are hitting home with you, maybe you were sold a bunch of the annuities, maybe your portfolio returns haven't really been that great, maybe you've bought stocks or investments that you know you haven't researched, and you haven't researched in the past, or you haven't researched in the future. Maybe you should attend one of our upcoming workshops and learn from others' mistakes. It'll save you a fortune. Folks, I'm going to take a quick break. I'll be back with more questions. Send those to Brian Rezny at ReznyWealth.com, and make sure you go to our website, ReznyWealth.com, for times availability of our upcoming workshops. If you'd like to sign up for a consultation with our firm to talk about our money management and the experience you will receive, go to ReznyWealth.com. I'll be right back after this. Hello, I'm Brian Rezny, president of Rezny Wealth Management. I've managed money professionally for over 30 years. The biggest mistake I see investors make: being sold an annuity. Annuities are sold on blatant lies, fake free money bonuses that never materialize for you, the consumer. Before your retirement gets ripped off by an annuity salesman, get my free report: Why Annuities Are Dangerous to Your Wealth and Retirement. And we're back, and I hope you're enjoying today's program. And as I talk many times in the past, again, make sure you understand what you're buying before you buy it, and make sure you keep doing that research after you buy it so you know when to sell. Gloria from Florida. I am 61 years old. Since my divorce, all my money is in IRAs, a total of about $800K. My financial advisor has me taking $8,000 a month minus 30% taxes, giving me about $5,600 per month to live on. I have no other financial assets. I'm scared that if a recession hits and all stocks crash, either way, I will not have enough money to survive and be broke sooner than later. Wow. First off, before I get into some of your general questions, it sounds to me like you've never done a financial plan with this financial advisor. So my guess is your financial advisor isn't really a financial advisor at all. It's probably a salesperson selling product. And it doesn't sound like you have a money manager. A real money management firm is going to do a financial plan or parts of it that are necessary for retirement. So again, retirement plan, we do that with our clients because it's important to know where they're headed based upon certain circumstances and their wishes. So let's go to your questions, Gloria. What can I do with my IRA to change them to a safer path for me to moving forward and avoid a catastrophic event, I'm assuming, and have my money last longer? And your second question, does it sound crazy just to take all the money out now, pay the taxes and penalty, and have a real number in my account moving forward so I can't lose any more? Help. Okay, what I'm going to say to you is this. You definitely need to find a real firm to manage your money. Find yourself a fee-only fiduciary money manager. Go to ReznyWealth.com. Scroll down to the bottom of our website. Download our free report, Real Advisor, Fake Advisor. Read it. Utilize that questionnaire. Check out the firms in the future that you entrust your money to. Your part of your question, should you liquidate your account, pay the taxes now? Absolutely not. But what I'm going to say to you is this, Gloria, and don't take this the wrong way. There's a lot of people like this. You sound very emotional when it comes around your money. If you're emotional and you're worried about your money doing a little bit of this over time or even having a temporary drop and then coming back, that is not good. You're going to make emotional decisions around your money. It's going to be detrimental to your wealth and financial security. I will tell you again, managing money as long as I've managed money. Investors that are emotional, that make emotional decisions around their money, create huge losses. And ultimately, you don't want to end up on the breadline or working at Walmart in the next 10 or 15 years. That's a mistake. Find a real firm to help guide you so you make better decisions around your portfolio. Go to ReznyWealth.com, check out our upcoming workshops, The Disturbing Facts Most Investors Are Shocked to Learn. Again, learn from others' mistakes. And Gloria, I'm going to put you in this group. Learn from others' mistakes. It's less costly to your financial security and your portfolio. Go to ReznyWealth.com. Nicholas in Florida. Do you see a rate hike in 2022, and how will that affect the overall economy? Great question. I would say this. We're going to probably see a rate hike in 2022. If we see a couple rate hikes, maybe. I personally think we're going to have very low interest rates for a long, long time. It could be the rest of our lives. I don't think you're going to see Jimmy Carter rates, that for sure. But do I see a rate hike? Very little. It's not going to have a big impact on the economy. And what I will say to you is this. The Fed is looking at the economy. They're looking at the investment markets. They're making decisions around that in addition to inflation and unemployment. If you start to falter the economy a little bit, they're going to back off the gas pedal. So a quarter-point rate cut or a half-a-point rate cut isn't going to change the economy much. But if it does falter a little bit, I think the Fed's going to be back on the gas pedal and it's going to be go time. Jim in Florida, thinking about buying an IUL, which is an insurance universal life policy for my kids. Listening to your show now, appreciate what would you do? Jim, there is no reason you should buy life insurance for young kids. You buy life insurance for replacement of assets you don't have, you and your wife, when you were younger starting out. So as an example, you guys are 30. You've got a couple young kids. You're both making $50,000 a year. If one of you passed away, the other one's going to be in hard financial shape. You would probably need life insurance. You need to calculate how much you need. The only kind of life insurance you should buy is long-term term insurance, like a 10 or 20-year term. Very inexpensive. Insurance agents, brokers, salespeople want to sell you the most expensive stuff there is, telling you all these bells and whistles to line their pocket. Don't do it. It'll break your bank, and that's not your goal and objective. Buy cheap term and invest the difference. Your kids are not breadwinners. They don't contribute to the household for you guys to live. So there's no reason for you to buy life insurance for kids. A lot of people are sold this stuff, but unfortunately that is a huge mistake for all investors. Folks, I'm just about out of time. As always, I appreciate all of your questions. Go to ReznyWealth.com. If you're tired of bad advice, if you're tired of conflicts that undermine your financial security, if some of the things I've talked about today are putting alarm bells up or they're questioning the direction of your portfolio or your so-called advisor, call my firm for a consultation. We do manage larger portfolios. Sad fact, most advisors are really salespeople selling the firm's products they are required to sell. Rezny Wealth Management. Feely Fiduciary Money Management. We actually manage your money, your wealth, and we legally work for you. Go to ReznyWealth.com, click on our consultation tab, and we'll see you next week.